Let's look at the board today. Opendoor Technologies trading in a heavily contested band, carrying a multi-billion-dollar market cap that captures the collective anxiety, exhaustion, and stubborn optimism of modern retail investors scrolling through their favorite trading apps. If you listen to mainstream financial media or scan the standard consensus commentary on Wall Street, the narrative around Opendoor is painted with broad, sweeping strokes of doom. They look at the top-line revenue contractions from previous cycle peaks, point to persistent net losses, and write off the entire iBuying category as a structural failure born out of an era of zero interest rate policy delusion. But while casual market participants in headline-chasing algorithm bots fixate on lagging backward-looking accounting metrics, they completely miss the fundamental physics engine of modern real estate liquidity, the friction coefficient of legacy home transactions. Traditional residential real estate is one of the most structurally inefficient, high-friction, legally encumbered legacy markets left on planet Earth. For decades, the consumer experience of selling a home has meant months of open houses, humiliating contingencies, broker fees eating 6% of lifetime family equity, and a terrifyingly opaque closing timeline. Retail investors checking daily stock charts see a volatile asset reacting to macro interest rate jitters, but they miss the hidden engineering reality underneath. Opendoor is attempting to digitize and automate the multi-trillion-dollar liquidity layer of residential housing using automated valuation models, AVMs, and machine learning pricing engines. While standard media pundits treat the company like a glorified, over-leveraged house flipper stuck in a frozen housing market, institutional capital quietly evaluates it through the lens of algorithmic infrastructure. The market mispricing stems from a profound disconnect between linear valuation models trying to price a tech platform using old-school brick-and-mortar real estate brokerage multiples and the reality of a company aggressively pivoting toward a capital-light, fee-based digital marketplace. When you dissect the daily trading volume and order flow of Opendoor, you witness a classic battleground asset. Macro jitters, shifting Federal Reserve rate expectations, and periodic housing data releases create violent intraday swings, shaking out impatient retail traders who bought the hype and panic-sold the dips. Yet beneath the surface turbulence, sophisticated institutional players and insiders play a completely different game. We have seen significant strategic moves, including executive skin-in-the-game buying and structural balance sheet maneuvers like opportunistic share buybacks, reducing share count alongside creative capital-raising vehicles designed to fortify runway. Before we peel back the operational layers of this digital transformation, let's pause right here. Are you currently holding a position in Opendoor, watching from the sidelines, waiting for a confirmed macroeconomic breakout? Or have you completely written off the iBuying thesis? Drop your thoughts and share your perspective below. To truly understand where Opendoor is heading, we have to strip away the outdated historical framing that haunts the company. For years, critics and even early investors mischaracterized the business as a cyclical property speculator, a digital house flipper exposed to the raw whims of local housing price volatility. In reality, that legacy model has undergone a profound structural metamorphosis. Opendoor 2.0 is actively transitioning away from a purely capital-intensive, balance sheet-heavy inventory model toward a scalable, fee-based marketplace strategy. At its core, the platform operates across multiple distinct vectors: the direct acquisition engine, where the company provides immediate liquidity to homeowners, the burgeoning agent partner network, and crucially, the integrated ecosystem of ancillary services, including title, escrow, and digital mortgage bundling. The traditional real estate brokerage model relies on human agents manually stitching together fragmented transactions while extracting high, non-scalable fees. Opendoor replaces that human friction with data science, automated valuation algorithms that ingest thousands of hyperlocal variables daily, and seamless software interfaces. By scaling products like their flexible transaction programs, the company is capturing transaction volume without necessarily absorbing the catastrophic tail risk of holding massive pools of vacant inventory on a leveraged balance sheet for extended periods. This shift from raw property speculation to a technology-enabled marketplace changes the fundamental economic identity of the firm. It positions Opendoor not as a victim of housing cycles, but as the underlying digital plumbing that real estate agents, institutional funds, and everyday consumers utilize to bypass the archaic bottlenecks of the 20th century housing market. Looking out over the multi-year horizon, the investment thesis for Opendoor hinges on a delicate balance of aggressive execution, technological gatekeeper positioning, and macroeconomic normalization. On the catalyst side, management's laser focus on achieving adjusted net income profitability, combined with accelerating adoption of AI-driven operational efficiencies and expanding contributing margins, serves as the primary near-term re-rating mechanism. As software-driven pricing accuracy improves and the attach rate for bundled mortgage and title services scales, each transaction becomes significantly more profitable, decoupling the company's bottom line from the sheer brute force volume of home purchases. However, prudent risk management requires acknowledging the formidable headwinds that remain. Opendoor operates at the mercy of macroeconomic cyclicality, a persistently frozen housing market characterized by low inventory turnover and elevated mortgage rates directly compresses top-line revenue velocity and strains liquidity. Furthermore, execution missteps in algorithmic pricing during sudden macroeconomic shocks can still lead to inventory devaluation write-downs. Yet, for investors willing to look past the short-term price noise and negative trailing gap earnings, the asymmetric upside lies in the digitization of an asset class that has stubbornly resisted technological disruption for generations. Look past the daily price noise, focus on the structural unit economics, and always keep your eyes locked on the long-term horizon.